welcome, and it's that time of the week again. It's the AutoJet Business Show. I'm your host, David Zidel, and we're going to talk business. David Shapiro, welcome.
Thank you. Nice to be here. No one, I hope the people listening, everybody's gone away, holiday tomorrow, gone home from work.
If they don't get you live, they'll get you afterwards on the podcast.
Okay, there you are.
So, David, I'm going to introduce you formally in a moment. I just want to run through, as I always do, a little bit of a business story, and then I'll come to you. And the business story today is something that Stephen Bartlett said. And Stephen Bartlett, he wrote a book called The Diary of a CEO. And he started a social media company or agency, and he did so well that he became the youngest Dragon's Den investor. And the Dragon's Den is where people take their businesses and they offer it on TV. It's like Shark Tank or Dragon's Den to the investors, and people can invest in their businesses. He was the youngest at the age of 28. He was already investing his own money in other businesses. And his words that he said was, embrace the fog. And the fog stands for feelings of growth. And when you look into the distance on a misty day, you don't really know where you're going. It's all fogged up. And that's what he says business is about, where, especially if you're going into a new area and you don't know what that's about, you've got to embrace that fog. You've got to embrace those feelings of uncertainty, not knowing where you're going. And it's that discomfort is always there when you're looking at something new. And rather than running away from it, rather than being scared of it, you need to embrace it. And therefore, he says, embrace the fog. And from last week's show, we had Brad Fisher, who was saying also along those lines about investing. Feel the fear and go for it anyway. But he said something else. He said, do it, but don't bet the farm. In other words, invest in yourself, invest in your business, invest in the future, but don't bet everything on one thing. At least if that fails, you've got something else that you can try again and again. And that kind of links into the investing and the things we're going to be talking about tonight with David Shapiro. So who's David Shapiro? David Shapiro, who is somebody on the 1st of February this year, celebrated 53 years on the Johannesburg Stock Exchange. And the stock exchange today, David, is very different to what it used to be. I know that now we're trading electronically, but I've been to the old stock exchange, Diagonal Street, maybe it was somewhere before that, where people used to walk on the planks, used to physically walk on the plank and write the share prices on the board. And maybe that's when you started, and it's changed completely, but the inherent things are still there. And David initially joined Max Pollock Fremantle as an unauthorized clerk. Now, I'm not sure why you were unauthorized, but that's what you were. And it was after you did your accounting degree at Wits. He's fulfilled executive roles. He's won 3 Raging Bull Awards. Now, those are unbelievable awards. If you have fantastic performances of a unit trust that you manage, you get those awards, and David's managed to get 3 of those Raging Bull Awards. Today, David actively manages private client portfolios for Sasfin Securities, and he sits on a number of investment committees, one of them being the Sasol Pension Fund. And he spends a lot of time in the media and on the radio commentating on the markets. He was voted Sasfin Person of the Year in 2013. 2023, he was honored by the South African Society of Chartered Accountants with a Social Impact Award for his contribution to the financial industry. And the amazing thing with David is he's contributed by making things simpler and explaining things in layman terms. He doesn't hide behind the jargon. He comes around the jargon so that all of us can understand. He's married to Linda, and he's been married to Linda since 1971. He's got 3 children, and all three of them are on different continents. He's got 8 grandchildren, 2 in New York, 3 in Sydney, and 3 in Joburg. Uh, David seems to do everything for the long run. So he's been over 50 years on the stock market. He's been married since 1971 for the long run. And I've seen David on the road as well, also doing the long run. Every morning, every day, he's running, physically running, not running away from anything. And besides that, he collects art, he draws caricatures, and there's only one small problem, and that's that he supports Arsenal, but you can't be perfect with everything. So, David, welcome. And I'd like to unpack, is everything in your life around the long term? We live in a world today where even on the American markets, CEOs of companies have to report every quarter, and they get hammered if their results for that quarter aren't better than the previous quarter. How can you run a marathon when people measure you every 100 meters?
Yeah, David, that's a very interesting view, because my motto is don't get get rich fast, get rich slow. In other words, just you've got to learn to ignore the noise. And even at the moment, we're going through so much noise, and the problem is that all my clients tell me they're there for the long term until the market goes down. Then you start to get the calls and questioning. And our job is to try and look through that and focus on the underlying businesses. I have a very simple way of investing. In fact, too simple. Most people, they believe that the more difficult it is, the more obfuscated it is, the more obfuscated the products are, the better it is. No. And my whole philosophy is around just buying maybe 20, maybe if you've got lots and lots of money, 25 companies, but you don't need it. And my view is that if you can't do it in 20 companies, you're not going to do it in 200 companies. If you understand what I mean, so you've just got to go and look for those 20 companies. And each of the 20 companies is like a marriage, like an affair. It doesn't mean sometimes you're let down by businesses. They don't fulfill the expectations that you have, but you've got to have that mentality. You can't be emotional. And it's not difficult. It's not difficult to look for the companies. The difficulty is the emotion of the market, going through these periods. There's a person, is at Satsford now. He's been on the market for a long time. I don't want to embarrass him by mentioning his name. Very well-known person, especially in the Jewish community. And he was saying to me this morning, he says, there's stocks that I bought for 50 cents. He says, today they're 100 Rand. When I told him the short term, 10 years, he says, no, for me, the short term is 15, 20 years, I mean, long term, sorry. So you've got to have that ability. Just to be patient. It doesn't mean David, there's a very important point. I watch the market all the time. And the reason is I keep asking myself every day, are the reasons that I bought these companies still relevant? Is it still relevant? And every day you go through that. If it is, carry on.
I'm going to stop you there for a second because we need to go to an ad break. But when we come back, I want for you to maybe unpack, if somebody has got a bit of money today, how will they find those relative companies? What are the key things that they're looking at? In other words, you said it's like a marriage. What do you need in a share to be married to that share? But we'll do that when we come back after the break. Welcome back to the AutoJet Business Show. I'm David Zidel. I'm talking to David Shapiro, and we're looking at investing in companies and how do you find the companies that you should be investing in for the long run? David, are there certain key factors that one looks at and you can say, okay, that's got potential or that doesn't, even though obviously there are no guarantees?
Yeah, we know that. If I had to go to a selection of people and say, what companies do you like? They'd tell me those companies. And the reason is that the first thing I look at is the product. You know, is it a product we use every day? Is it a product that has got brand power? In other words, it can raise prices if it has to, sorry, and you'll still kind of buy it. What about the technology? The other point is, when I say brand recognition, is it dominant in its industry? Warren Buffett always uses the word moat. In other words, like the old castle with a moat around it. It's got that protection. So if I looked, what I'm trying to explain is, take Apple. We all know Apple. We automatically want an Apple phone. You're already starting to cross, the hurdles or jump over the hurdles. Think of a Visa card. You use it around the world, or a MasterCard. Coca-Cola. When we go into a store, even though we don't let our kids drink Coca-Cola anymore, we know the brand. It's got a certain appeal. We're going to buy that brand above some other cola, so on. Those are the kind of things that you look for. So if you look at Microsoft, if you look at Apple, if you looked at Google, these are the businesses with that muscle. I'm just giving examples to say this is not too difficult to go through those kind of things. Of course, over and above that, I don't, could spend hours going through all of this, but management, very important, incredibly important. You want people that you trust and have monitored. When you've got young people, everybody wants to make money straight away. They hear something at shul, they hear it on the golf course or wherever they are, and straight away they want to fall in love. That's almost like meeting someone overnight. You go on a great date, the next morning you don't propose. You've got to know that person a little bit more before you actually propose. So don't be quick to jump into businesses. You can have the patience, learn a bit more about them, and learn to trust the management. And you monitor that over time. When they give results, is the management there for you or for themselves? In other words, do they pay themselves fancy salaries and so on? You're getting the drift of what I'm saying. I think financial health is important. What do we look like? What do you look for in financial health? Remember, I'm an accountant. I am not an economist, and I always look at the cash book, and I look at what they generate in cash, what they pay shareholders, in other words, give back to shareholders, also what they have left over, number one, to put back into the business. David, that's so important. What are you putting back to maintain your brand? Because you have to keep that brand going against competition, and you have to put in research and development, going back to technology shares as well. If you look at an Apple, if you look at these businesses, Google and Microsoft and businesses like that, they put back an enormous amount, and that's why they're ahead in artificial intelligence. Simply, they generate so much cash that they're able to build up new data centers. They're able to build new products. They can afford NVIDIA chips and so on. I think the other thing is customers. You've also got to check. You've got to be good to your customers. You've got to be good to your staff. You've got to have that kind of name in the market. Are they, do the staff like them? If you go to Capitec's customers, they love them. They absolutely love Capitec. And that's why it puts them ahead of all the other banks, in a way that the customers love them. The staff love them. And the other thing is suppliers. Very important. What do suppliers think of you? So, I mean, in a very quick way, these are some of the factors that you look at. Ethical as well. I think ethics very important. The community. What does the community think of the business as well? So you can tick those boxes, and it's not difficult to tick those boxes. I think the problem, David, so many people want to make money fast, so they always look for these obscure businesses out there, etc. And yes, you can sometimes do very well out of them, but are they going to last? Because you want to look 3, 4, 5 years ahead. Is this business still going to be around?
So you've said they got to look at the product. So it's the brand power of the company. You've got to look at, are they dominant in their market? When you talk about the moat, is it hard for somebody, the barriers to entry? Is it hard for someone else to come in?
Yeah.
They've got to have good management, financial health, in other words, have the cash. Are they putting cash back into the business? Um, do
Mm.
they have good customers? Do the customers believe in them? Do their own staff believe in them? You spoke about the suppliers. Do they have a good relationship with
Yeah.
their suppliers, and are they ethical? So this is an unbelievable list of things, but how does how do I go and see that, or do I need to find somebody like you to find that and tell me, or can I do it as a somebody I've got a few thousand rand to invest? Can I go and investigate that myself?
Well, you can abdicate the role of doing it yourself and give it to a financial advisor. But there again, you better check that financial advisor. You know, you got to check the trustworthiness of it. But I'm talking about you've got to spend time. You've got to spend time on your financial health. You know, we all spend time on our spiritual health, on our physical health. Financial health is important as well. So you've got to do this kind of reading yourself, and if you've got money, you got to spend time looking after it. Or if you do have a financial advisor, then you ask the financial advisor these questions. Tell me, and you say, what's the product like? So whatever that financial advisor puts you into, you can ask those kind of questions. They're not difficult questions. And it's the same thing. It's the same thing as buying a fridge, buying a motor car. You go through all these kind of iterations before you actually buy. It's strange that I say that, because when it comes to the stock market, when you come off the golf course and someone told you, go buy this, you don't even think, you go buy it. And that's where we make a lot of mistakes. Just take it slow. Take it. Don't, as I say, get rich slowly. You don't have to get rich fast. Mm.
So it's like, I think it's got to do with the FOMO, the fear of missing out.
Mm.
And I think that's
Mm.
what gets people to jump in as quick as they can. If you're wondering who we're talking to, I'm talking to David Shapiro. He's talking about investing in the stock market. And David, so you've told us to look for these things to get married to the
Yeah.
company or to the share. When you decide to get divorced, and I know
Mm.
you invest for the long
Yeah.
term, and you
Yeah.
don't divorce yourself from shares often. Have you divorced yourself from some
Oh, yeah.
shares, and what made you do that?
That's when they start to lose that appeal. I was a big follower of Disney. And in many cases, it's that the industry is changing. It's not necessarily the business, but it can be the business. So I'm using Disney as an example. I'll give you another example as well in a second, in a second. But Disney, not because of Disney itself, but it's funny. I looked at my grandchildren, and they weren't watching Mickey Mouse anymore, or Goofy. They were going to Bluey or all kinds of people, kind of movies that I've never seen in my life before. It's strange how their tastes had changed. I think that was kind of an example, a warning sign. Star Wars, no longer the appeal that it had. And there were a lot of issues like this. I'm not against Disney and where they are, but you could feel that they were losing their place in the market. It's something like that. I think the other thing, and this is where also made an important thing. David, you're old enough. You're not as old as me, but you remember going to the movies, or you remember television was our only form of entertainment, and we would watch adverts. The Charles Glass Society for for beer, or Peter Stuyvesant. They used to glamorize smoking and so on. And what that allowed those companies to do is to put their products in the front of everybody when you walked in a store. Things have changed now. Things are TikTok, Instagram, Snap, YouTube, you name it. So the younger people or other people are now learning to buy products by going on to Instagram, where you've got influencers. Suddenly, the companies that we knew in the past haven't got that same brand power. The other thing is that many people are now buying down because they haven't got the same kind of wallet that they had, therefore looking at home brands. And that made me say, okay, time to change, getting out. And I'm using these companies as an example. For example, a Procter and Gamble, a Colgate, a Nestle's, businesses like that just haven't got the power. So I made a switch out of those into the people who now sell home brands would be a Costco or a Walmart and so on. So I'm giving examples of the kind of switches when you do make changes. Those are the kind of things that would influence you. But you've got to be bold, and this is where it comes from reading and from watching and observing. There's certain brands, David, like Nike, Adidas, and they're too fickle. You've got to watch your customers as well. When they switch from one to another, and every day then you've also got to say, okay, I don't like that industry, much too fickle for me. So you've also got to look for those sustainable industries. I know we're going through, it's very difficult to get all of this into a very short time, but those are the kind of those are the kind of things that we go through when we do make changes. Is it still relevant? Is Nike still, it's a wonderful, wonderful brand, but suddenly we've got on cloud, you've got Roku, you've got a whole lot of other things that are coming through. And so you've got to make decisions around that as well, despite the fact that they're still very, very good brands. The investment side is a different thing.
So you basically looked at Disney and you said, this is a Mickey Mouse organization.
Yeah, it was. Exactly. It'll
and
come
Mickey
back.
Mouse and Mickey Mouse didn't have that appeal. Yeah.
But that came from streaming, the same thing. Streaming changed the whole way that we watch and entertain ourselves as well. And, from that point of view, it started to lose the appeal to other brands.
So what you're talking about is the fundamentals of the business, looking at the fundamentals. But when you look at what we call technical analysis, that's looking at the graph and looking to see, there's that saying, the trend is your friend.
Yeah.
But then they say the trend is your friend until the bend at the end.
Yes.
And do you follow that at all? Do you use that as well? And how's that different from the fundamentals that you've been talking about?
I'm not a technical analyst. Technical analysts don't necessarily look at the fundamentals. They only look at the technicals, and they follow price movements, and they're able to read patterns from that. I like to look at charts because what charts do show you, and I'm just looking at the simplest of charts, simply, as you said, the trend is your friend. And it gives you an idea of what people think of the business. And why I do that, for me, it's an intelligent service. And sometimes when I think the fundamentals are great and the chart's moving in the other direction, in other words, the smart people are getting out, those who know a lot more than I do, then I take cognizance of it. I say, okay, something's going wrong. We read the fundamentals, we read analyst reports, we read all of this. They're telling us that direction is upward, share price going down. Okay, what's wrong? And then you've got to go and start searching. The same happens in the other direction when things are really bad and it starts to turn up. Then you've got to find out, okay, what is happening there that I've missed that is positive? So I love to look at the mark. I love to look at charts in that sense to try and get a direction. I like to buy businesses where the chart goes from the bottom left hand to the top right hand. Those are the kind of businesses I like, not those that go from the top left to the bottom right.
Often if it does that, and then you get up right at the top, then you've got the fear that it's going to come down. So how do you get your timing right?
Difficult, with great difficulty. It's so hard to time the market. I would never, for no money in the world, would I trade with somebody else's pension. It's impossible. And I say that as a person who literally looks at the market, sits in front of a screen the whole day, reading, doing what I have to do. And I watch the market. And if you can read the rand, if you can read the rand, get it right for 2 or 3 days then I'll give you an award, Traders Award, because the amount of volatility that we see. And David, you mentioned the old time market that I started on, which was an open outcry. And you look at the trading markets today, which are internet driven, algorithm driven, with huge amounts of money coming in from all over the world. There's huge amounts going in and out and so on. to try and trade and to try and get on top is almost impossible. So that's what we're fighting against. You're fighting against a trade, and that's where you've got to say what is noise, what is not noise.
I'm going to ask you about that noise. What is noise and what is not noise? But we've got some important noise to put in, which is our ads. So I'll ask you after the break. Welcome back to the Ort Jet Business Show. I'm David Zidel. I'm talking to David Shapiro, and we're busy unpacking the art of investing and looking at the timing of buying shares. And there's always that old saying, it's not the timing, but the time in the market. And David, just give us a little your take on that. I think you agree with that statement, but even if you do agree with it, we always look at, somebody will suggest a share and you say, well, go and look at the fundamentals, and you go and you have a look at the fundamentals. And then we look at the chart and we see where it is. How do you decide when to get in? And you say you're there for the long run, but also when you get divorced, you say, well, you watch the charts, but now, even right now, as we talk about the markets have been down. Some of those top shares you spoke about, Apple, etc., they're down 15, 20%. Is now the time to buy more? Is it time to get out? How do you make those kind of decisions, especially, as you say, when you're looking after someone else's money?
I think that's very difficult, because you understand that you are looking after someone's pension or savings, and that puts a huge responsibility on yourself. Look, you have to. It's like any profession. It takes time. It takes time to build up experience. One can't do it overnight. And if you are going to do it for somebody, you have to do your apprenticeship. You have to be mentored, and you have to take your time, and you have to know what you're doing, and you've got to put your time in. I don't want to say this, but I promise you, I get up 4:45 in the morning and drive my wife absolutely dilly, because I turn on the TV to find out what's been happening in other markets and so on. And you try to learn what's happening in the news, and throughout the day, you're keeping in touch. I always say to people, and believe me, I learn a lot more from reading results. I don't know much about economics. I don't know much about, if you had to ask me inflation and going through all monetary economics and so on, I don't know. Where I learn from is by going through business results. And you don't have to be clever to do that. You don't have to read the hundreds of pages that are published and the hundreds of spreadsheets that are published. Just read about the business. Say, how did they make the money? What product do they sell? Who do they sell it to? What kind of margin do they? What kind of, those simple questions that we discussed earlier on. But religiously, I try to go through as many results as I can on a day-to-day basis. Today there was momentum. Momentum came out with really very good numbers. Now, momentum, in our view, has always been. It's always been overshadowed by Sanlam, and it's always been overshadowed by maybe Old Mutual or Discovery and other. And here they came out with these really good numbers. And that alerts me, hold on a sec, maybe look at it. Admittedly, the top line was a worry, because and that's a South African issue, they're not selling at the top line. But you go through those results to say, read a little bit more. All it does is makes you a little more cleverer for tomorrow. And I do that for all, whether it's ArcelorMittal or whatever it is. You go through the numbers to learn about what's happening in the economy, as well as offshore as well. I listened to NVIDIA. I listened to Jensen Huang the other night. I listened to Powell overnight and that. So you've got to do the hard work, like running a marathon. You can't just get out there and run. You've got to do the training. And it's like any profession. You've got to do the work, and you've got to keep at it and be disciplined.
On the South African market, and I don't know the numbers anymore. I know that it's going down, but maybe the 300, 350, 400 companies on the South African market. If you look at the American market, it runs in the thousands. How do you keep track with all of that? How do you sift out and say, what am I going to look at?
That's a good question, because what we do is that, first of all, I'm going back to my choose 20 stocks. So I don't invest in South Africa, not for political reasons, not for economic reasons, just that our businesses cannot keep up with the quality of those businesses overseas, in the US markets. So that's it. And so, but it doesn't mean I take my eye off what's happening here. And I keep asking, are these businesses, can they compete with my top 20, my top 25 that I have there? There again, we keep a very narrow focus because you can't cover 3,000 businesses. It's impossible. 30,000 businesses. So I keep it very narrow and keep a very small universe. So I know what companies my clients hold. And we keep, looking for new businesses all the time. If we find a new business, is this new business better than the worst business that we have? In other words, like the Premier League. You've got your Premier League. Some companies get relegated, others get, come up, promoted. So when you want to buy a new company, is this better than the worst that we have? So you keep yourself very disciplined from that point of view as well. So, but you've got to, there again, you go through you go through as much as you can. I have to tell you that AI is a revelation, absolute revelation. For your few dollars a month, you can go on and you can summarize what's happening. You can get a transcript of a meeting, say an NVIDIA meeting or a Microsoft meeting, and you put it into AI and say, just summarize, tell me what the main points were. And here you get it. I say, this is great. This is wonderful. So, but you got to do it. You got to get those transcripts and that. But it's easy to do that. So it's a lot easier to do what we do than perhaps it's coming through. You just got to make those leaps. You spoke about the fog and so on. You've got to get through that kind of fog and have the confidence. So start slowly. Start, don't have to rush in. Just do these things very quietly, easily, and get your confidence going.
So you're saying you'll invest in like 20 shares, and then when you find one that you think you're going to invest in, you get rid of what you now see as your worst share. So you're not buying. People think about diversification and then they diversify into 400 shares. Then you might as well buy what they call the index, where you're just buying the average of the whole market.
I promise you out there listening to the show, if we do have listeners,
just because it's a holiday.
Many people that have got funds and unit trusts and ETFs and so on. You probably find that they're exposed to something like 2,000 or 3,000 shares through these huge number of exposure, of funds that they go into. When you analyze that, you'll probably find it's only about 50 odd shares that actually create their wealth. So we come back to that and say, okay, and we do this exercise all the time. You just find thousands of shares in portfolios, and I say, okay, so what's number 3,000? How much? What is number 3,000 of those shares? How much is it contributing to your wealth? You'll find nothing. It's to the fourth decimal point. So why you got it? So we take those 50 shares and we even take them down lower to 20, 25. So we've got a universe that we watch. So we've got 10 shares on the bench, or we're constantly looking for businesses. But, it's got to get to a point where you feel that you want to own it and you're quite happy to perhaps let go of some of the other companies that maybe not contributing to the extent that you want them to.
So you talk about an ETF, and I'm sure, have you heard what a TLA is? So a TLA is a 2 or 3 letter acronym. So an ETF fits beautifully.
It's an exchange traded fund, yeah.
It's an exchange traded fund. It's a basket of all the funds. So again, we're going to go to a quick ad break, but when we come back, I'd like to ask you, do you think that it's better to look at your universe of 20 shares or invest in an ETF, especially for someone who's investing for the first time? Welcome back. It's 10 to 7. You're listening to the Ortjet Business Show. I'm David Zidel. I'm busy chatting to David Shapiro, who's unpacking investing in the market for us. And just before the break, David, I asked you about the ETFs. Is it better for someone who's new to the market to put it into an ETF, meaning they take their money, it's split over thousands of
Okay.
different shares, or should they do what you're suggesting now, look at these 8 different things within a company and try and invest themselves?
If I was a beginner, I would certainly put my money in a tracker fund, or in other words, an index fund or an ETF. ETF, as you say, a basket of shares. Let's say, for example, now what I would do as a beginner, I would go into, say, the S&P 500 or the NASDAQ. NASDAQ has a lot of tech shares, and yeah, put 50, 60, 70, 80% of your portfolio in that. Take the other 20% and say, okay, I'm going to try and buy a few shares with it. And as the confidence comes, so you start to switch, so you start to get out of your trackers and go into more shares. There's nothing wrong with owning trackers. In fact, most of my local portfolios where we can't get money out are in those ETF, are in those trackers, those that track the S&P 500 or track. At the moment, I like the FANG. The FANG are the Magnificent Seven, those top, all the tech shares, because I think they've knocked the tech shares a little too far. I think they're looking at very good value at the moment. Your Microsoft, your Apples, your Nvidias, yeah. So I think this is a rare occasion where they have been sold down and are starting to look very appealing at these levels. So
they're starting to show their fangs. And
yes,
my question
exactly.
was going to be, in your opinion, will it come back, do you think?
Oh, no doubt. Absolutely no doubt. I think we underestimate how AI is going to, change the way that we live, change the way that we do things. Now, I always say this in a snotty way. I said, because there's so many analysts out there who sit in lofty towers, who belong to all big investment houses, who are dispensing all this incredible and valuable information, on spreadsheets and that. But go to the source. Listen to Mark Zuckerberg or listen to Jensen Huang. Those are the people running the companies. And that's why I say, nowadays, you can go on to you can get a transcript of what they say. You can listen to them. You can log into their presentations. So you hear it from the people running the business and rather get their views. That's once more, I say, David, you understand who you can trust.
But can you trust them? Or they're not just selling their company for the sake of selling the company?
You've watched them over time. You've watched them over time. That's what I say. That comes with that kind of trust. Someone like Satya Nadella from Microsoft, honest, decent, good person, or Tim Cook from Apple and that. Look, they can't get everything right. It's impossible to get it. But when they tell you what their order book is like, what it looks like, and that's why I say you go to Nvidia now and you listen to what Jensen Huang says about the future. I mean, it's absolutely astonishing what's going out there, what kind of money, the speed at which these chips are going to respond. I mean, you can't get it around your head. So I think that's for me, that's the source of the information that you've got to start building up. And I use that as as the kind of research that we do.
So would you invest in Nvidia, or would you invest in the company making the chips that Nvidia
all of them
uses?
All of them.
All of them.
So I like this chain that goes from ASML, which is the Dutch company that makes the machines that Nvidia makes the machines that TSM, Taiwan Semiconductors, makes for Nvidia, and they then sell it on to Amazon and to Microsoft and to all the companies. And then it goes down to the further chain, which is like someone like Salesforce or Accenture or ServiceNow, who are the software developers. They take the company and say, okay, we will design the software so that you can use all this phenomenal artificial intelligence. So that's the kind of chain that you get.
So I was going to ask you which companies should somebody look at, but I think you've kind of given a list of them.
Yeah, yeah. I think
So
that's I'm very much into that. But again, you've got to be careful. Just do it within limitations. I think the other big theme are the weight loss drugs. I mean, it's a mammoth. It's for once we've got these drugs that are making a huge difference to people's lives. These are the companies Novo Nordisk and Eli Lilly who are producing these GLP-1 blockers. These drugs that are used for obesity and for diabetes. But the benefits from them are quite remarkable. Of course, every second person who sits in financial services, goes through the test results and understands them, which I'm being cynical, so
yeah.
but the companies themselves, if you listen to what the businesses tell you about where these are going, it's quite phenomenal. And it's going to change the way people's lives, it's going to change people's lives. So you get these themes. My other big theme as well is I love luxury. I don't use luxury. I drive a small car. I don't wear a watch. But when you look at businesses like Hermes and LVMH and Ferrari, you've got a different customer at a different level. Those businesses are phenomenal, where you've got a $3 million car and you can't get it because there's a waiting list. You've got to know that there's something special about these businesses. I'm talking Ferrari. I have
And
no idea. I couldn't tell. I couldn't tell. What do you call it? Especially when they go around the Formula One. I have no idea. But all I know is that these are really phenomenal businesses.
the LVMH, what's that
Well,
one?
that's Louis Vuitton.
Louis
Yeah,
Vuitton. Okay.
Louis
You
Vuitton.
see,
Also,
I'm at the same school as you. I don't invest
yeah,
in these luxury things. Interesting thing what you said around the weight loss drugs. I don't know if you've been watching actual Weight Watchers, the shares. That has crumbled. It's about
yeah,
90%
yeah, yeah.
of
Because,
what it
yeah.
was. And so can you be overweight on the Weight Watchers or on uh,
You can
weight
be
drugs?
overweight the shares. You mean
The
be
shares, yes.
overweight the shares, not
And not
overweight the
the
weight. Yeah, yeah.
right.
I use that in another thing with where it comes to luxury. I keep saying, buy the shares, not the product. In
Yeah,
other words.
100%, 100%. David, unbelievably, it's now time to wrap up. I can't believe it's 2 minutes to 7, and I'm getting a sign from Craig who's saying, please wrap up. So thank you so much. I can't believe how the time's gone. This has been David Shapiro. I'm David Zidel. This has been the Jet Business Show.